Hey traders, I've been getting quite a few emails regarding static and dynamic bars, more info on them. Can they be only used with a certain trading style? Can it be used with any trading style? Is it only for intraday? So I want to give you a brief overview of static and dynamic. First question is, why use static and dynamic bars? Well, we all heard of the top-down approach, analyzing charts from the top down. Well, one main problem technically is, how far is the top? I mean, you'll see some intraday traders referring to the weekly. I mean, wow. Even then get into the monthly. So every chart that you look at, to be objective, you need a trade. You need something in your plan for it. What are you looking for? So by the end of the day, you're spending more time creating a rule for the weekly than you could in refining your entry or your risk management. This, in a sense, incorporates the top-down approach. Whatever time frame that you're using, for me at this point is the 5 minute. For some it could be the daily, for some it could be the 30, or whatever it is. This is my top-down approach. What static and dynamic bars do, it actually looks at the chart from a micro standpoint. So while looking at your macro chart, which for me is going to be the 5 minute, it tells me what the micro time frame is doing. And we all also know the saying that before your macro time frame or your higher time frame can change, the change will occur in the micro. So if we can pick these changes up in the micro, then that can help us determine when the macro might change. I found out that red and green bars can be misleading. Now, I've been trading a while, and all through trading, any trader that's really into trading always looks to see how he can progress and make himself better to be the best trader that he can be. And I love challenges. I love to analyze things and see if I can dissect and conquer that information. Based on bars, sometimes individuals can say that prices being extended, prices going up, but those aren't an actual fact. Or you have to identify these bunch of, which I've done also, top and tail, bottom and tails, bunch of major reversal bars to identify possible changes. Well, period. Slowing in momentum is static. I mean, simple as that. I mean, this is the static and dynamic is not rocket science. It's just a real simple concept. Slowing in momentum is static. Pickup in momentum is dynamic. That's the one basic concept. But how does this relate to the micro time frame? Well, we could just look at this, for instance. Whenever we get, say, a dynamic bar, static bar, dynamic bar, I call that a set. Any dynamic bar, static bar is a set. So static bar, dynamic bar, static bar, dynamic bar, that's one set. So basically what this is right here, this, once you have a one set, that on your second set, that is a uptrend in the micro time frame. And so relative to support and resistance, this right here is major support in the micro time frame. Right here, this is major support. We have static, new high. The time is which is dynamic, static, new high. So in the micro time frame, this is major support. So I mean, whether you want to, whether you're using support, resistance, supply or demand, or whatever the scenario may be. And so basically, in many cases, below a dynamic bar's low, if you're managing something, can be used as a stop. Just like this right here. When you have 4 or more static bars, that's a range in the micro time frame. So we know that that's a breakout. Whether these are blue or green or yellow, I mean whatever color they may be, it doesn't matter. This is a range right here. This is the breakout. We're trending. So we were already trending, so major support was never violated in the first place on a micro time frame. So what this allows you to do is look at a micro picture. And the only time you need to even look at your smaller time frame is when this sets up. When this sets up for your particular location or entry, whatever it is, then you open your time frame up to narrow it down to refine your entry. So this can be used with any time frame, and you have to decide which smaller time frame best suits your trading plan. So then you can decide yourself if you start to get more than 4 or 5 or how many static bars in a row that your plan may deem.
The time is 12 o'clock p.m.
Do you want to trade, or do you want to let it break out? Already do the breakout. And so once it break out, then see if you have an entry. So those are little simple tools that we can very easily see with using static and dynamic. And here we can see that the micro is not trending yet. We haven't had a second set DB here. So we had a breakout, but we know it's not trending yet. And ideally, also we know that it still stopped, of course, around the dynamic bars low. But the ideally is we like to enter when it's less interest in the market before everybody sees the direction. So generally we like to enter on static bars and sell your position on dynamic bars. So that's the benefit of, well, an additional benefit. So these were just a few tips and explanation on why static and dynamic, and that pretty much sums it up for now. Okay, traders, later I'll maybe do another video and do a few more key points. And earlier it was a moment of silence. I don't know, I thought I paused it, so I'm not sure if I recorded everything, but we'll see.